All right, today we're going to decode one of the most powerful yet least understood forces in the global economy, bond yields. For a long time, they were this really obscure metric, but not anymore. Now they set the rhythm for, well, pretty much everything. If you really want to know what's coming next for markets, you've got to follow the yields. And for decades, that's exactly what they were. Bond yields were this sleepy, predictable thing, kind of the domain of pension funds and insurance companies. They were the quiet, honestly kind of boring corner of the financial world. So, what happened? What changed? Why is suddenly everyone, from central bankers to your cousin who just started investing, paying such close attention to this once ignored number? That is the big mystery we're going to unravel today. Okay, to really get a grip on their power, we first need to learn how to speak their language. So let's dive in. What message are bond yields actually sending us? So this slide might look a little complicated at first glance, but really, it all boils down to three core things. A yield is the market's real-time, no-nonsense judgment on the reward you get for lending your money, the risk that you won't get paid back, and, maybe most importantly, the level of trust in the person or government you're lending to. It's all of that captured in one single number. At its heart, the definition is pretty simple. It's your total reward for patiently lending out your capital, assuming the borrower, which is often a government, makes good on all its promises. You could say it's the price of time and the cost of trust, all rolled into one. Now, this is where it gets really, really interesting. This inverse relationship, think of it like a seesaw. When investors get scared and they rush into the perceived safety of government bonds, the demand pushes prices up and that forces yields down. But when doubt starts to creep in about, say, inflation or out-of-control government spending, investors start selling those same bonds. The price falls and the yields rise almost in protest. So, if yields are a language, then the yield curve is basically a weather forecast. You see, bond markets are like a super cautious disciple. They have this uncanny ability to signal the coming economic storm long before the sky even starts to get dark. Let's see how that works. This map right here, this lays out the whole story. The key thing to get is that bond markets signal what's coming, not what's happening right now. They don't shout, they whisper. And those whispers tell us which of the four economic seasons we're heading into: expansion, peak, the late stage, or even a recession. So let's break down what those signals actually look like. Okay, let's walk through it. During an expansion, yields just kind of drift up gently as things get better. At the peak of the cycle, though, short-term yields jump because central banks are hiking rates to fight inflation, and that flattens out the curve. And then you get the most famous and most feared signal of all, inversion. This is when the yield on a short-term bond is actually higher than on a long-term bond. That's totally backwards. It's the market basically screaming that it sees serious trouble ahead, a warning that economic winter is coming. And finally, in a recession, short-term yields fall off a cliff as central banks slash rates to try and get things going again. Okay, so that brings us to right now. Yields have been rising, and rising sharply. So why? Well, you could say the market is charging a higher anxiety fee. Let's look at the three main reasons for all that anxiety. The first reason is, no surprise here, inflation. Think about it. A bond promises to pay you a fixed amount of money down the road. But if inflation is running hot, that fixed amount is worth less and less every single day. So investors, pretty logically, demand a higher yield to make up for the fact that they're getting paid back in shrinking dollars. And man, this chart just perfectly illustrates that dance. You can see it so clearly. As those blue bars, that's inflation, shot through the roof starting in 2021, the red line, the 10-year Treasury yield, followed it right on up. They are locked in this reluctant but absolutely undeniable rhythm. The second big driver is just massive, massive government debt. When government spending starts to look like an all-you-can-eat buffet where nobody ever intends to pay the bill, investors start to get nervous. They wonder if they'll be paid back with real, disciplined fiscal policy or just by printing a whole lot more money. That uncertainty means they demand a higher yield to compensate for that growing risk. And the third reason? It's just plain old chaos. Political gridlock, social unrest, unpredictable policies. This chart shows a chaos index in blue, and in red, something called the term premium. Just think of the term premium as that extra bit of interest investors demand for the risk of locking up their money for a long time in an uncertain world. And as you can see, when chaos goes up, so does that anxiety fee. It's a powerful idea. The premium rises not because the future got any longer, but because our trust in that future got a whole lot shorter. Okay, so let's pull the camera back a bit because this is not just a domestic story. Not at all. Yields are one of the primary forces moving capital all around the globe, and in doing so, they end up shaping the destinies of currencies and even nations. I absolutely love this analogy. Global capital is like a huge swarm of caffeinated tourists. Money is constantly, restlessly searching for the best return it can find. But, and this is a big but, it'll only stick around if the neighborhood feels safe. So, higher US yields attract all that tourist money, which strengthens the dollar. But if those yields are rising for the wrong reasons, like deficits or chaos, those same tourists will pack their bags and vanish at the first real sign of trouble. And check this out, you can see the effect in real time. On the left, we've got the yield difference between US and German bonds. When that green area is high, it means US yields are way more attractive. Now, look at the chart on the right. That's the euro to dollar exchange rate. They are almost perfect mirror images of each other. When US yields rise relative to Europe's, capital floods into the US and the dollar gets stronger. It's really that simple. But beneath the surface of all this, there's a much deeper and frankly more unsettling geopolitical story playing out. You see, when the world's main reserve currency is also used as a weapon through things like sanctions, its biggest creditors start to, well, think twice. This chart shows a really crucial trend. China, one of the biggest foreign holders of US debt, has been steadily, methodically reducing its holdings. So the big question is, where's all that money going? Well, take a look at the blue line. As China has been selling off US treasuries, that's the falling red bars, it has been quietly and dramatically ramping up its gold reserves. They are literally trading paper promises for a hard physical asset that has no counterparty risk and crucially cannot be frozen or sanctioned away. This isn't just a portfolio shift, it's a profound statement about trust. Okay, so we've covered a ton of ground. What does this all mean for you? What are the key lessons here? How can you actually use this knowledge to read the economic winds yourself? All right, let's boil it all down. If you remember nothing else from today, remember these things. First, bond yields are the market's lie detector. They cut right through all the political noise. Second, the so-called risk-free asset is only as safe as the government standing behind it. Remember that rising term premiums mean trust is getting shorter. And definitely remember that when a currency gets used as a weapon, its biggest creditors will start quietly looking for the exit. And that, right there, is why physical gold remains that timeless, essential hedge against reckless government decisions. You know, all these incredible insights and the powerful visuals we've been looking at today, they come straight from the work of the Macro Butler. So if you want to go even deeper and learn how to navigate these really complex markets yourself, you can visit his website at themacrobutler.com or contact him directly. We'll leave his details right here on the screen for you. His email is info@themacrobutler.com. And we'll leave you with this final thought. Financial yields, they're always going to fluctuate with debt and politics and fear. But an investment in knowledge, that's the one thing that compounds persistently, year after year. So in a world of growing uncertainty, maybe the most important question to ask yourself is, what are you investing in?